Attention all U.S. retirees in 2026. Major changes are unfolding that could directly impact your Social Security, healthcare cost, retirement benefits, taxes, and monthly income stability. And most people are completely unprepared for what's coming. In today's video, we're breaking down the 6 most important things every retiree must know right now to protect their money and avoid costly surprises that could affect your future security. So don't skip a second. And if you want clear, simple updates like this on retirement, pensions, and financial changes that actually matter to seniors, make sure to subscribe to this channel now, because here we only focus on real updates that retirees in the US need to stay ahead and stay protected. If you are retired or about to retire in the United States, 2026 is not a year you can afford to sleep through. This year is packed with changes, some that will quietly put more money in your pocket, and others that if you are not paying attention, will take money right back out before you even realize what happened. We are talking about shifts in your Social Security check, what you are paying for Medicare, new rules around your retirement accounts, taxes on your savings, and opportunities that most retirees simply never hear about until it is too late to use them. So whether you are already drawing benefits or you are in that final stretch of working years trying to figure out when to pull the trigger, the next few minutes could genuinely be worth thousands of dollars to you. Let us get into it, because there is a lot to cover, and every single thing we are about to discuss directly affects your financial life right now. Let us start with the one thing that virtually every retired American has been waiting for since last fall: the Social Security Cost of Living Adjustment, better known as COLA. For 2026, benefits went up by 2.8% beginning in January. Now, that number might sound small on paper, but what it means in practice is that the average retired worker is now receiving approximately $56 more per month than they were in 2025. If you are a widowed spouse receiving survivor benefits, your check went up by about $52 per month as well. Over the course of a full year, that adds up to somewhere between $600 and $700 additional dollars landing in your bank account, which is nothing to dismiss. The Social Security Administration calculated this adjustment using the Consumer Price Index for urban wage earners and clerical workers, a federal measure of how prices changed from the third quarter of 2024 through the third quarter of 2025. Inflation ticked up enough during that window to push the 2026 COLA slightly higher than the 2.5% increase retirees received in 2025. And it came in above the 2.8% mark for the first time in several years. For context, the 10-year average COLA has historically hovered around 3.1%, so 2026 lands just underneath that long-term average. But here is where it gets complicated, and where a lot of retirees feel the sting of what looks like good news on the surface. That 2.8% increase does not land in your account whole. Before that extra money even touches your bank balance, Medicare Part B premiums come out of it first. In 2026, Medicare Part B premiums jumped to $202.90 per month. That is an increase of $17.90 from the $185 per month you were paying in 2025. On a percentage basis, that is a 9.6% increase in your Medicare premium in a single year. So when you do the math, a retiree receiving that average $56 monthly increase from COLA and then subtracting nearly $18 in higher Medicare premiums is left with a net gain of roughly $38 a month. Better than nothing, absolutely, but nowhere near the full 2.8% raise the headline number suggests. Advocacy organizations like the Senior Citizens League have been vocal about this exact issue, pointing out that COLA calculations do not fully capture the costs seniors actually face, particularly when it comes to healthcare, prescription drugs, and housing, and that many retirees end up feeling poorer even in years when their benefit technically goes up. Understanding this gap between the headline number and your actual take-home increase is critically important as you plan your monthly budget for the rest of this year. Now let us talk about one of the most significant milestones in all of Social Security policy: the full retirement age. As of 2026, the full retirement age for anyone born in 1960 or later is officially 67 years old. This is the final step in a gradual change that began back in 1983, when Congress, facing the reality of an aging population and a strained system, passed legislation to slowly raise the retirement age from 65 to 67. That 4-decade process is now complete. What this means in practical terms is that if you were born in 1960 or later, you must wait until age 67 to claim 100% of the Social Security benefit you have earned over your working life. If you claim earlier, as early as age 62, your benefit will be permanently reduced. Claiming at 62 locks you into a benefit that can be as much as 30% lower than what you would have received at full retirement age. On the flip side, every year you delay claiming beyond your full retirement age earns you what Social Security calls delayed retirement credits, which increase your benefit by 8% per year all the way up until age 70. There is no financial reward for waiting past 70, so that is the ceiling. The decision of when to claim is one of the most consequential choices a retiree will ever make. And for many Americans, the difference between claiming at 62 versus waiting until 70 can represent over $100,000 in lifetime benefits. If you have not sat down with a financial professional to model out your break-even point and your optimal claiming strategy, 2026 is the year to do it. The third thing every retiree needs to understand in 2026 involves the earnings test, a rule that catches millions of people completely off guard. If you are collecting Social Security before reaching your full retirement age and you are still working, the government has limits on how much you can earn before it starts temporarily withholding part of your benefit. In 2026, that earnings limit is $24,480 per year, which works out to $2,040 per month. If you earn above that amount, Social Security will withhold $1 for every $2 you earn over the limit. So if you are pulling in, say, $36,000 a year from part-time work, and you are simultaneously collecting Social Security before full retirement age, you could be losing a significant chunk of your benefit every single month. There is also a separate, more generous limit for the year in which you actually reach your full retirement age. In that transitional year, the limit rises to $65,160 annually, and the withholding drops to $1 for every $3 over the limit. The critical thing to understand is that once you reach full retirement age, the earnings test completely disappears. You can earn as much as you want from working without any reduction to your Social Security benefit. The money that was withheld during earlier years is not simply gone either. The Social Security Administration does recalculate your benefit upward once you hit full retirement age to account for the months your benefit was withheld. But the timing and cash flow implications in the short term are real. And if you are currently working and collecting early benefits without knowing about this rule, you may be in for an unpleasant surprise when tax season arrives. The fourth area retirees absolutely cannot afford to ignore in 2026 is required minimum distributions, or RMDs, and how the Secure 2.0 Act is reshaping the entire landscape around them. If you have money sitting in a traditional IRA, a traditional 401k, a 403b, or most other tax-deferred retirement accounts, the IRS requires you to start taking withdrawals at a certain age, and the rules have changed significantly in recent years. Under the Secure 2.0 Act, if you were born between 1951 and 1959, your RMD starting age is 73. If you were born in 1960 or later, you get even more time. Your RMDs do not have to begin until age 75. This is a major shift from the old rules, which required distributions to begin at age 72 under the original Secure Act and at 70 and a half under the rules that existed before that. For those born in 1960 or later, the new age 75 threshold essentially gives you up to 5 additional years of tax-deferred growth compared to what retirees were dealing with just a few years ago. And if you have a Roth 401k, not a Roth IRA, but a Roth account inside your employer plan, here is news that may surprise you. Starting in 2024, Roth 401k accounts are no longer subject to required minimum distributions at all. Roth IRAs already had that exemption, and now Roth 401ks have joined them. That is a powerful planning opportunity that many retirees and near retirees have not yet taken advantage of. But here's where people get into serious trouble with RMDs and why this topic deserves your full attention. When your required minimum distributions start hitting your income every year, they do not arrive in a vacuum. They stack on top of your Social Security income, any pension payments, and any other taxable income you have. The cumulative effect of all that income coming together can shove you into a higher federal tax bracket than you expected, potentially increasing the percentage of your Social Security benefits that are taxable. Up to 85% of your Social Security can become taxable income depending on your combined income level. And it can also trigger what is known as IRMAA surcharges on your Medicare premiums. IRMAA stands for Income Related Monthly Adjustment Amount, and it is Medicare's way of charging higher income retirees more for their Part B and Part D coverage. The IRMAA thresholds for 2026 start at $109,000 in modified adjusted gross income for a single filer and $218,000 for a married couple filing jointly. If your income exceeds those thresholds, your Medicare premiums can jump dramatically. We are talking hundreds of extra dollars per month in some cases. And here's the part that really stings. Medicare uses a 2-year look-back period, meaning your 2025 income determines your 2027 Medicare premiums. So decisions you are making right now about withdrawals, Roth conversions, and income management will directly affect what you pay for Medicare 2 years down the road. Missing your RMD, by the way, carries a penalty of 25% on the amount you should have withdrawn. On a $500,000 IRA with a $20,000 required distribution, forgetting to take it costs you $5,000 in penalties. Do not let that happen. The fifth thing retirees need to know about in 2026 connects directly to the RMD conversation, and it is one of the most powerful but underused tools available to people who are charitably inclined: the Qualified Charitable Distribution, or QCD. A QCD allows you to transfer money directly from your IRA to a qualifying charity of your choice, and the amount you transfer counts towards satisfying your required minimum distribution for the year while being completely excluded from your taxable income. You never report it as income. You never owe federal income tax on it. It is as if that money never existed from a tax standpoint, even though it came directly out of your retirement account. In 2026, the QCD limit increased to $111,000 per individual, meaning a married couple where both spouses have their own IRAs could collectively transfer up to $222,000 to charity this year without triggering any federal income tax on those distributions. For retirees who already give to their church, to hospitals, to universities, or to any other qualifying nonprofit organization, this is an almost incomprehensibly good deal. If you were going to make that charitable gift anyway, and you were also going to have to take your RMD anyway, combining the two through a QCD lets you accomplish both goals simultaneously while dramatically reducing your taxable income for the year, which in turn can keep you out of higher tax brackets, keep your Social Security benefits more sheltered from taxation, and potentially keep your IRMAA surcharges from kicking in. The QCD has been described by many retirement planning experts as the single best tax move available to retirees who give to charity. If you have not talked to your IRA custodian about setting one up, make that phone call this week. The sixth and final thing every retiree or near retiree needs to understand in 2026 is the opportunity that exists right now for strategic Roth conversions and why the window for doing this may be narrower than you think. Here's the setup. If you have stopped working but have not yet started taking Social Security, or if you have not yet hit the age where your RMDs kick in, you may be in what financial planners call a low income window, a stretch of years where your taxable income is at its lowest point in decades. During those years, you have the opportunity to convert money from your traditional IRA or traditional 401k into a Roth account, paying income tax on the converted amount now at today's potentially lower rate, in exchange for those funds growing completely tax-free from that point forward and never being subject to required minimum distributions. The math behind this strategy can be genuinely staggering. A couple in their late 60s with a large traditional 401k who begin systematic Roth conversions during the gap between retirement and age 73 or 75. Converting amounts carefully sized to stay below the IRMAA thresholds can dramatically reduce the size of their future RMDs, potentially saving tens of thousands of dollars in taxes over their lifetime, while also keeping their Medicare premiums lower for years to come. The key to making this work is sizing each conversion carefully. Converting too much in a single year pushes your income into higher brackets and potentially over IRMAA thresholds, while converting systematically over several years can achieve the same total tax savings and a much lower effective tax rate. For workers aged 60 to 63 who have not yet retired, there is also a separate benefit worth noting. Under Secure 2.0, catch-up contribution limits increase significantly in 2026, with people in that age bracket now able to contribute up to $11,250 in catch-up contributions to their workplace retirement plans, well above the $8,000 limit available to everyone else over 50. If you are in that 60 to 63 window and still working, that is free additional tax-sheltered space that many people are leaving on the table. Stepping back and looking at all 6 of these areas together, a clear picture emerges. In 2026, being a retired American is more complex and more full of opportunity than it has ever been. Your Social Security check is larger, but Medicare is taking a bigger bite. The full retirement age milestone has been reached, making your claiming decision more consequential than ever for anyone who has not yet filed. The earnings test remains a trap for early claimers who are still working. Required minimum distributions carry penalties, tax implications, and Medicare surcharge consequences that catch people off guard every single year. Qualified charitable distributions offer one of the cleanest tax advantages in the entire tax code for retirees who give to charity. And Roth conversion opportunities during low-income windows represent potentially the most powerful wealth preservation move available to those who act before their RMDs begin and before tax laws potentially change again. The through line connecting all of this is simple. Information is money in retirement. The people who know these rules, who plan around them deliberately, who work with qualified financial advisors and tax professionals to model their specific situation, consistently come out ahead by thousands, sometimes tens of thousands of dollars, compared to those who simply let their retirement income happen to them without any active management. You have worked your entire life to build the savings and earn the benefits you have today. 2026 is the year to make sure every dollar of that works as hard as possible for you, and that not a single dollar goes to taxes, penalties, or missed opportunities that could have been avoided with the right knowledge at the right time.